we're going to talk about some of our favorite stocks to buy right now in January. And before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we are doing on YouTube. Again, fool.com/Frankel. So both of us have similar companies, similar in the sense that they're the same industry. They're actually two very different size companies, different focuses, things like that. But one of the stock that I think is a real kind of fluke opportunity almost right now is Prologis, ticker symbol PLD. They're the leading industrial real estate investment trust in the world, not just in the industrial space, but in the world. They're the largest holder of real estate. 1.2 billion square feet of rentable space. If you've ever seen one of those Amazon fulfillment centers, it's about the size of 5 football fields. There's a solid chance that Prologis is the owner of that. Their top tenants are Amazon, Home Depot, FedEx. They operate on 4 continents. And it's not just those big companies. They have 6,700 different tenants. A total of, and this is kind of a crazy statistic here, 3% of global GDP flows through Prologis warehouses. So very, very big and important company. It's down significantly, down more than 20% from its recent high. The big reason is interest rates. There are a few other reasons that I'm going to get to, but interest rates are weighing on the real estate sector. I'm going to go ahead and take this opportunity. Tyler, enjoy this. I'm going to say Tyler was right. Interest rate increases happened a lot slower than pretty much anyone thought they would. At the start of 2024, I think a lot of people were predicting 6 or 7 rate cuts. We got a total of 4. They didn't start till September. A lot of people thought they were going to start before. And more importantly, when we got the latest rate cut, the Fed's accompanying projections showed that the Fed members themselves are not projecting rates to fall very much in 2025 at all. That kind of caused the rally in income-focused stocks, real estate stocks, to kind of stagnate. So Prologis is down about, as I said, about 20% from its recent high. Not only do higher interest rates make it more expensive for REITs to borrow, that's kind of the secondary reason, but commercial real estate valuations are based on a metric called the cap rate, which essentially is the yield on a cost of a property, and cap rates they track interest rate, the interest rate environment. For industrial properties, just based on a kind of cap rate analysis, they've risen from about 4% to about 5.5% over the past couple of years. And I'll save you the math or the real kind of economics explanation of that. That means industrial properties are worth about 20% less than they were a few years ago, if Prologis were to go sell it or something like that. So that's a big reason. And there are economic fears. There's a lot of fear that industrial properties were overbuilt during the pandemic, which they kind of were. And as a result, Prologis's occupancy is down from about almost 98% to under 96% in the past few years. That's more of a normalization than a cause for concern at this point. Its retention rate is down by 70%. There's a lot to like about this here. Like I said, it's trading at a significant discount. It's underperformed the market for a few years now. E-commerce is a big tailwind. I've mentioned that before. Prologis is quietly getting into the data center space, and they have the capital to do it right. They have access to very cheap borrowing, things like that. They're planning to spend about $8 billion building data centers by 2028, and that could just be the beginning. They have great developmental expertise, meaning that they're really good at creating value through developing new properties. Just kind of as a basic explanation, if you could build a property for $10 million and it's worth $15 million when you're done building it, you've created $5 million in value. They do that on a very wide scale. I think rate cuts are still going to happen, just obviously slower than I originally thought. But I do think the direction of interest rates over the next 2 or 3 years is going to be downward. And there's a lot of embedded rent growth in their portfolio. And after this, I'll stop. But during the pandemic, rents for industrial properties really skyrocketed. A lot of Prologis's leases were started before the pandemic era boom and still have a lot of rent growth when they reset to market rates in their 7-8 year leases. So we're going to see more of this kind of come to market over the next couple of years. So Prologis is my pick for right now, and probably the best stock to buy in 2025, in my opinion. as we head. As far as a risk reward standpoint, it's probably my favorite. But Tyler, you have a very similar but different company. What do you have?
Well, I mean, it is very similar. It's also an industrial real estate company.
Right,
It's Rexford Industrial. Um,
different
tickers
scale,
are
much different scale.
much different scale. The ticker is REXR. Um, Same idea, industrial real estate, but it focuses entirely on the Los Angeles, San Diego County, Orange County kind of area, Southern California. Um, in large part because number one, that's a massive market. Like the industrial warehouse space of that whole Southern California area is like bigger than Germany's. So it's a pretty robust market in terms of industrial real estate. And also the fundamentals for it are just very favorable. The vacancies tend to be lower than national averages. Rents tend to be higher. Rent increases tend to be higher, and it's also in a net shrinking supply area. There's a lot of rezoning that that happens in this area, and when they rezone, they tend to rezone out of industrial to like mixed use or commercial or things like that, or like mixed use commercial and residential. So you have this shrinking supply of land available for industrial, which makes for the market fundamentals for a company operating in this area pretty good. Rexford has been particularly good at making acquisitions. They're really good at like finding off market deals. I don't know, maybe their CEO is like drinking buddies with the commercial real estate agent that operates the whole Southern California area. But it's been one of the ways that they generate value is they are able to get more favorable cap rates, as Matt was saying, than you would be able to do that if like the thing got listed and all of a sudden you got in a bidding war for these things, because they're typically buying them off market before they even get listed. So a lot of kind of structural advantages to what they do on that, like the leased spreads and the increases that they're seeing in their most recent report. Oh, this was in November, but kind of give you a rough idea of what we're talking about here. It said that its comparable rental rates on new and renewal leases was up by 80% on a net effective basis and 60% on a cash basis. So that's that difference. Like when we release this to our customer, we were able to jack the rents by 60%. And then its annual rent increases are closer to 4% now. So even higher than inflation. A lot of like embedded aspects. Now, I think part of the reason the stock is down, number one, like I said, interest rates. Number two, because of I want to call it like geopolitical. This isn't necessarily like political in like Democrat, Republican, but more in kind of like this larger shift away towards like reshoring, friendshoring, basically becoming a little less reliant on Chinese imports. The Long Beach, Los Angeles ports handle like 40% of all container ships coming into the United States. And so industrial real estate is tied to a lot of that. And so if you see a slowing kind of economic ties between China, there's a decent chance that like slowing activity in that port, slowing activity for industrial real estate. So there's some kind of valuation concerns there. And I don't think it's an issue yet, but obviously the Los Angeles fires could be an issue. Maybe, I don't know. That's too soon to tell, but that's what insurance is for too. But you kind of tally this all up, and yeah, the things it's not the prettiest looking outlook right now. But right now, at its current price, it has a forward dividend yield of 4.37%, which is the highest it's ever been as a publicly traded entity. It went public in, I believe, 2013, 2014. Yeah, end of 2013, and yes, the 2010s and early 2020s was like this zero interest rate phenomenon time when everything had low interest rate or low dividend yields. But 4.3% with a company that has grown its payout at better than double digit rates ever since inception, that in my opinion is a pretty good trade-off. And so yeah, it might not look like the prettiest thing on paper, but I think it'll be worth it.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.